what's going on. I mean, right now, investors are just wedded to this false paradigm that can't happen. The Fed is hopelessly behind the curve. It's impossible to catch up.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
Look at the news that came out last week about the BRIC nations. This is Brazil, Russia, India, and China. These countries are now launching a new common currency for trade, so that they can trade with one another and use this new currency instead of the dollar. And the game changer is the new currency is going to be backed by gold. So it's not really a new currency, it's old money. It's gold as money functioning through a new currency, which the BRIC nations are creating, and they're going to use in commerce instead of the dollar. Now, I don't know the timetable when they're going to officially launch this new currency, but any currency that is pegged to gold is going to be a superior currency to the US dollar, which is pegged to nothing. And so once this currency is out there, I expect more nations other than the BRICS to start using it, especially if they want to import what the BRICS have to export. So once this currency is out there, more and more nations and more private companies, that's also going to be part of it. It's going to be private companies that are going to prefer this method of payment over the US dollar. And again, that's going to especially be true given the recent weaponization of the dollar, where a lot of people and nations will be afraid of the dollar and their vulnerability there based on the whim of the US to impose sanctions based on whatever it thinks some country did wrong. I think you're going to see just more impetus to move into this superior currency, and it couldn't happen at a worse time for the dollar. Again, that's what people just don't get. We've got record trade deficits. We've got record budget deficits. How are we going to finance these record twin deficits? Financing them is impossible. The only thing that we can rely on, or method of financing, is going to be inflation. The Fed is going to be printing a lot more money to monetize all of this debt. Otherwise, interest rates are going to be prohibitively high. That is another fact that everybody is missing when they are just looking at these CPI numbers. But also, I think that the markets, again, the stock market in particular, is setting itself up for a 1987 style crash, a big decline in a single day when investors wake up to reality. They've been living in this fantasy, the fantasy of inflation coming down. This fantasy is going to be pierced, I think, by the falling dollar and by the effect that's going to have on the bond market. Today's rally notwithstanding, the bond market is breaking down. And I think it's going to continue to break down, especially if the dollar's going down, commodities are going up. Because remember, if you're a foreign investor and you own US treasuries, you own dollars. And so if you are getting Forex losses, and remember, there were a lot of people who were optimistic on the dollar. Everybody's been bullish on the dollar. All of these theories, dollar is the safe haven. People are going to buy the dollar. The Fed is hawkish. The Fed is tough. So there probably are a number of international investors who got into treasuries as a play on the dollar, not just to get yield on the treasury, but as a way to invest in the dollar to benefit from an appreciating dollar. Well, if the dollar starts to depreciate instead, then a lot of people are either going to dump those treasuries or they're going to have to hedge their foreign currency risk by shorting dollars, by selling dollars to hedge their treasuries. But that just puts more downward pressure on the dollar, which puts more downward pressure on treasuries. And a weak dollar puts upward pressure on commodity prices and the CPI, which also puts downward pressure on treasuries. So I think that what's going to happen is that the bond market is going to follow the dollar lower. Gold's going to move higher, and these trends are going to continue until the stock market can no longer ignore what's going on. I mean, right now, investors are just wedded to this false paradigm that can't happen. It's going to take something to shake confidence. I thought maybe looking at the way the markets reacted last week to the jobs numbers, that maybe the confidence was shaking. Apparently not yet in the stock market. Now, maybe we'll see. We have a few more hours to trade today. Maybe we'll get a reversal. I mean, the Dow is only up 140 points right now, so it's off the highs. The NASDAQ earlier today hit a new high for the year, and it's still up there. It's up 1.28%. So there's no sign of any kind of turn going on in the NASDAQ. But these are the stocks that investors should be selling the most, but they're still buying these stocks because they're more interest rate sensitive. And this shows you that the markets are anticipating a drop in interest rates. And they anticipate that because they believe the Fed has succeeded in bringing down inflation. And that has set the stage for these rate cuts. And everybody is just trying to get in front of that by piling into these tech stocks. Well, in mass, they're going to be getting rid of these stocks when they discover that that is not the case, that the dollar is falling and that inflation is taking off. I mean, the low inflation rates that we had were the aberration. It really is amazing that we went over a decade with these sub 2% inflation numbers. It lulled a lot of people and central bankers into a false sense of complacency, and a lot of people expect those days to return. They still don't understand how much of an aberration that was, and they don't understand the extenuating circumstances that made that possible. It was the voracious appetite for US dollars by the BRICS, by China, by India, by Saudi Arabia, by Russia, Japan, which is not a BRIC, but a lot of these countries were gobbling up dollars. That enabled us to export all of the inflation that we were creating. We're not going to be able to do that anymore. We're going to be re-importing that inflation as our trading partners send it back to us. They do that by spending their dollars, by taking the dollars that they had in US treasuries and buying stuff, whatever we got. They're just going to buy it and they're going to bid up the price. Oh, by the way, before I forget, I didn't mention this on the last podcast, but even though that the job number was a big disappointment, the major contributor to jobs, I forget the number, I don't have it in front of me anymore, but it was government jobs. Government jobs was the biggest component of that weaker than expected report. And these government jobs are particularly inflationary. Why? Because when you put people on the government payroll, the government has to pay their salaries. Well, where does the government get the money to pay their salaries? It prints it. It runs larger deficits. That's where the money is coming from. You know, these workers aren't generating profits. You know, they're just expenses that the government has, and the government has to pay their salaries. The other problem is they don't produce anything. These government workers are not adding to the pool of goods that people can consume, but they're going to subtract from that pool because they're going to take their government paychecks and spend them. They're going to buy stuff that they didn't help produce with those paychecks. So it's bigger budget deficits. It's more money printing. It's more upward pressure on prices. That is what everybody is missing. They're missing the deficits are, the budget deficit's blowing out of control, $2 trillion, and all the upward pressure on inflation because they're focusing on the improvement. Sure, we are at 9% year over year CPI. Okay, so we've had an improvement. We've gone down to a little bit below 5 or 4, whatever. People are focusing on that small improvement without putting everything in its proper context and recognizing the ebb and flows that are likely to define this new inflation wave. Because remember, the Fed didn't even see this wave coming, right? And so now they think, okay, it's done, or people think it's done. They have no clue because they don't understand where it came from. Again, they're still fixated on the supply chain bottlenecks from COVID. They still think, it was all about COVID. It was a one-off thing. And now everything is fixed. The Fed raised rates. By the way, the Bank of Canada raised rates today. They're now up at 5%, but they've still got a ways to go. They've got a big inflation problem in Canada as well. But again, this also puts more pressure on the dollar as other countries start pushing up their rates. The difference between the rates in the US and other rates are not as great. And so there's even less incentive from a yield perspective to hold on to US dollars. But the bigger picture, again, is that we're not going back to those sub 2% days because this is not just about COVID. COVID really, was kind of like the spark that lit the powder keg. And I talked about that in real time. I talked about the absurdity of that monetary and fiscal policy combination in early 2020. I was one of the few people who was warning about inflation early in COVID when everybody else was talking deflation. Everybody was saying, demand's really going down because of COVID, because everybody's staying at home. I was the guy that pointed out, no, it's not going down. Demand is going up because everybody is getting their stimulus money. People have more money to spend during COVID than they had before COVID. But I also pointed out the fact that we weren't producing. So supply was going down as demand was going up. So that really just it lit the fuse. But the fuse was long because it's been building since 2009, 2010, QE1. I mean, it actually started before then, but it really kicked into a higher gear. It's just that we never experienced the consequences in consumer prices. I mean, we experienced it in asset prices. I mean, those prices went up, stocks, bonds, real estate, other collectibles. We saw it in global macroeconomic imbalances. We saw it in debt levels. We saw an explosion of debt, corporate debt, government debt, consumer debt, student loans, credit card debt, auto debt. So all of those consequences of inflation were there. It's just that nobody cared about it. Nobody worried about it because it wasn't showing up in the CPI or the personal consumption expenditure index, whatever government metric the Fed claimed it relied on. So as long as the inflation wasn't there, nobody cared about it, but they should have cared about it. They should have been worrying about it. And because nobody worried about it, it got so out of control. The Fed is hopelessly behind the curve. It's impossible to catch up.